Okay, hello and welcome everyone to this live intraday strategy webinar on SB Trade Desk. Michael Boutros here with you this morning. Great to be here with you, Graham, Eileen, Hussein, Medad, Mir, Pete, Pooja. Good to be with you here, this morning. Looks like a little bit of a light day here in the city. Not much going on. Imagine a lot of people still on holiday break. For those of you who celebrated yesterday, 4th of July, I hope you had an awesome evening. It was raining here in New York, so the fireworks spectacular was a little bit offset, but nonetheless, back into price action to start the week. It is a big week for markets. Don't forget, is the opening range for July. We're heading into non-farm payrolls on Friday. As it pertains to non-farm payrolls, I'll give you more background information on that as we get deeper in the week, but certainly everyone's going to be looking at it. Look, the Fed's job is becoming harder and harder. They're between a rock and a hard place. Every data point is going to shift interest rate expectations moving forward. Not only because the global risks that we're seeing posing the Fed and really limiting their ability to begin to normalize, but also the drop-off that we had here in U.S. economic data. So certainly the non-farm payrolls print will be sort of the highlight on the week heading into Friday. But ahead of that, obviously, you still have a long way to go. Looking at interest rate, we'll move into that in a moment. Before we get started, a real quick look at relative performance for the greenback as we head into the U.S. Open. You can see that the dollar is stronger than most of its major counterparts here, save the yen, which is up 0.68%. Biggest loser, British pound, down 1.28%. So we'll take a look at that. I'm not really trying to mess with the pound crosses yet, guys. I do think this is going to offer a beautiful opportunity for a longer-term sterling long position, but not from these levels just yet. And we'll want to see how the opening range for the month pans out. Euro, Swissy with some lackluster price action. Aussie will go over first. That obviously on the back of the interest rate announcement last night. The RBA holding steady at 1.75%. So as we go through these guys, if you have any questions, trade setups you'd like to review, I'm kind of light as far as how many pairs I'm following at this point. We'll go over Aussie, CAD, Swissy. We'll touch on Euro. We'll touch on Pound. Gold coming into an interesting area of resistance near 1358. We'll talk about that. And as always, your questions and trade setups are always welcome. So let's jump right in. Before we do, here's what the dollar index in and of itself looks like. And I do want to bring up real quick what we looked like last week. Here's what the intraday chart looked like heading to the close of last week. Key resistance, 12,064. Near-term support at this confluence right here near 1938. Here's what the index looks like now. You did see a nice little rebound here. We've covered Friday's range, essentially. Now we're testing the monthly open, okay, which essentially comes in right around, so I can tell you right off the bat, 11,968. Okay, and that's basically what we're testing today. Today's high so far, 11,996. So certainly we've pushed through. We're testing that monthly open at this point. Here's what the intraday chart looks like for the dollar index. So you can see last week we essentially held the weekly range into the close. And again, here's the monthly open, backed by the weekly open, near-term resistance. So if we do see a topside break here, look for a rally towards 12,064. On the pairs, that would suggest downside pressure in Euro. I would expect to see in such a scenario downside pressure in sterling. On the dollar weakness story, I'm a little bit more prone to favoring Aussie longs, and we'll go over that in a moment. But on dollar strength, if we do pop through the monthly and weekly openings, look for some downside pressure in the pound and the euro. Eileen says, is there a specific link to for using TradingView? Yeah, it's tradingview.com, Eileen. There's a link for you right there. Tradingview.com. So almost done with the transfer. It's going to take a little bit longer. This is what I've got so far. So if you guys have any questions on any of these pairs, we're all set up and ready to go. But certainly we'll be shifting over to this trading platform or this charting platform over the next few weeks. You got it, Eileen. All right. So we'll be keeping our eye on these near-term targets for the dollar index. Again, on the broader view here, is what the daily chart looks like. Okay, so we see a near-term breakout out of this descending channel formation off the yearly high. Really, I mean, I was looking for a drop into this support right here as initial, but we obviously rebounded ahead of that. The monthly opening range shaping up pretty nicely below that 200-day moving average. Okay, so a topside break, 12,064 is sort of the major key resistance. You have a 50 line for the current operative structure off the low there. You have a 618 key retracement of the entire 2016 trading range. And if we do see that topside pop through that 200-day moving average, that's sort of your initial area of interest for possible resistance on the dollar index. So what does this mean for the pairs? Well, for the majors, again, I think you want to take every pair on its own merits here before we start to flush into any basic bias on dollar shorts or dollar longs. I do want to bring your attention to Jamie's seasonality piece, or the seasonality reports rather, on where we stand with the dollar index. Here's what the dollar index looks like. And heading into July trade, certainly the seasonalities turn lower early in the week. Now, the DXY seasonality is a little bit different from the US dollar index, which kind of plateaus on the bottom side, kind of bottoms midway through the month before recovery. If you look at the ICE dollar index, it's a little bit more apparent for some dollar weakness heading into the start of the month. In fact, if I'm not mistaken, yesterday's swing update also had, here we go, with the DXY. So you can see the DXY a little bit more of a prominent decline here, with the seasonalities closing October much lower from where we are right now. Really steep drop off. So we'll be looking for some high or a high in dollar index to start off the week. I do think you try to probe through the monthly open here, maybe even attack that 200-day moving average, but we're broadly looking for some or a high in the dollar index heading into the start of the week. Well, we're already in Tuesday, but you know what I mean. All right, so keep that in mind as far as the dollar index is concerned. Any questions on this before we move off? Could see a little bit more of a rally here, looking for short triggers as we head into that 200-day moving average, the monthly open, key resistance and bearish invalidation, 12,064. All right, let's jump into the Aussie dollar. So here's what Aussie dollar looks like on the daily and the 30-minute. And before we get started, here's one thing I just want to bring your attention to. Obviously, they held interest rates unchanged, 1.75%. I just wanted to highlight where interest rate expectations have shifted. Some takeaways from last night's RBA statement. Inflation quite low for some time is expected. Okay, that fuels expectations for interest rate cuts. Why? Well, typically the monetary policy in a deflationary environment or a disinflationary environment will tend to lower rates. That'll tend to stoke inflation. Now, they're already at 1.75. That's one of the record lows here for Aussie. If we look at interest rate expectations, I pointed this out yesterday. From where they are now, you can see a dramatic shift. Here's the July print, only looking for 13. That was this month. Here's August, looking for 46% chance of a cut, now raised to 48. September, 54, now raised to 56. So you're seeing interest rate expectations for a cut start to mount, start to rise. The initial reaction obviously is going to be bearish the Aussie, but I don't think you want to start chasing that lower. Remember, we weren't expecting a cut yesterday. We've broadly been expecting further interest rate cuts to the main refi rate here from Australia. So all you're seeing is a repricing for a little bit higher of a likelihood that we're going to get that cut. Is that worth an Aussie reversal on full on? I don't think so. So on the way down here for the Aussie, I am looking for some support. Here's what or some other comments, by the way, effects of the British or the Brexit vote on the global economy remain to be seen. It's another cautionary stance saying that the central bank is poised for further action if we do start to see the Brexit vote filter into a little bit more of a risk-off trade in broader markets. So you can tell a little bit of an uneasiness there from the RBA. From a price action standpoint, here's what Aussie looked like yesterday. We highlighted this key resistance here, 618 retracement again of the decline off the yearly high. Key support, you have a nice confluence right here of the 100-day moving average, the 50 line of the current operative structure off the low, and the 50 line of the current operative structure off the high. The best performer out of all the majors as far as median line analysis is concerned has been the Aussie. I mean, if you look at this chart on whole, there really hasn't been another pair that's been quite as clean as this formation. Pitchfork catching the highs, catching the lows, median line catching the highs again late last month, off the highs, catching the lows, pivot on the median line, catching the highs. Okay, so we're going to continue to follow this formation. I think it's been very, very fruitful here. And near-term support and bullish invalidation basically extends into this reason, 74.30 into 74.50 basically, or 74.45. Looking at that 100-day and then that median line confluence just lower. Here's what it looks like on the 30-minute chart. And here's what we look like last night. Okay, so I noted that we were coming off resistance. The immediate long bias was vulnerable heading into that 70-50 region as we were trying to push through that upper median line parallel or basic channel resistance. Again, the actual RBA release did charge a nice rally right back into that median line before reversing sharply. Really nice opportunity to get short against the opening range high for the week. Again, this was a little bit too late for me here in New York, but the trigger was definitely there for a move lower. Now, we've already filled the Sunday gap really early in the week. Only took a few hours into Asia trade before we filled that gap. And here we are again. This is the gap from last week. Okay, and you can see it offered some near-term resistance here. That'll be your first soft support target. Still major key support down here. Remember that 74.40 level we just noted on the daily chart. You would have to get through the monthly open. And again, we're only a couple of days through the month. And the weekly open. So I'd be looking, if this drop persists, for some long exposure, long triggers into this key region. And again, the major key upside resistance still 75.70. So if Aussie's going to continue on this upward slope off the lows, that's sort of where we would want to find some initial support. Let me just give you a little bit more of a picture of what we're looking at here. As far as Aussie data for the remainder of the week, there's not really much on tap. You do get home loans. Actually, that's next week. There's really not much on tap for the remainder of the week as it pertains from the Australian market. So you'll really want to be looking at U.S. economic data for the remainder of this week. And here's what the docket looks like. Today at 10 o'clock, you do get the factory orders for the month of May. These are going to be the biggest prints for the day. These are just the final prints for durable goods for the month of May. So unless there's any revision, don't look for any volatility on this. This is going to be the bigger print for U.S. trade heading into today. Obviously, tomorrow, the minutes released from the latest FOMC policy statement will be also pretty important. I mean, the last policy statement was a quarterly one, so we got the presser. We really got to press Janet Yellen a lot of questions, so I don't necessarily think you'll get too much off the minutes tomorrow, but definitely something to be mindful of around 2 p.m. Any questions on Aussie? Looking lower immediately, but still interested in long exposure here if we come into some support, either at the weekly, monthly open, or that key confluence region that we highlighted on the daily chart. All right, so that was last night's update on the RBA interest rate decision. Again, it's pretty, I don't want to say expected, but pretty run-of-the-mill, right? Really keeping the cautionary stance, leaving room for further interest rate cuts if they need to. And certainly the market has been pricing that in with that move we're seeing here today. Now, if the market was really caught on the wrong foot with regards to expectations from the RBA, this drop would have been much larger than it is. And that's one thing you want to keep in mind, right? Although we saw interest rate expectations for a cut start to build, the losses have been pretty tempered. Again, giving you an idea or giving you a notion that the broader upside swing here and the momentum still remains pretty constructive. The only thing I am concerned about, is this turn right here ahead of 60. That's sort of a textbook turn ahead of resistance and momentum, suggesting that you still have a little bit more risk for a decline on the immediate term. Okay, That is Aussie Dollar. Moving right along, I do want to go over the radar charts from last week. No change to these. Guys, if there's no change to the radar charts, it just means that the levels remain exactly the same. Here's a dollar CAD looks like on the daily chart, or on the 30-minute, excuse me. As I noted last week, heading into the close, or heading into Friday, I was holding a short on dollar CAD. We were looking for a move into that 28.98 region. Here's what the 30-minute chart looked like as we were heading into Friday's trade last week. Here's dollar CAD right now. Okay, so, excuse me. The daily chart doesn't really have too much to get excited about. We're still holding within the confines of this nice ascending channel formation. Basically, you're still holding the range that we set for the last 2 days to start off the month. We're right above the monthly open as it stands right now. Momentum for the last couple of weeks, 60-40, 60-40, real lackluster. Near-term price action, I think, is where the tell has been here on dollar CAD. So you can see last week, got a clean opening range break to the downside, shifted our focus lower, looking to move into the lows for the week. There's that target. Again, at the open on the onset of the week, we finally triggered that last quarter. The trade got taken off on that dip into 128. We got out before the low. 128.99 is where our limit was. So we got taken out early in the week on this decline. And here's a potential for a near-term breakout. Okay, these wedge patterns typically are continuation patterns. And here's the breakout taking us back above the weekly open and back above the monthly open. Okay, now momentum on the 30-minute also crossing into overbought for the first time since the Brexit vote. And here was the Brexit rally. So certainly from this standpoint, it does look like you can have a little bit more of an upside target. I would be looking for this rally to peter out earlier in the week and offer some nice opportunities to get on the short side. If you tack on a quick retracement of the near-term descent just off the highs from last month, you can see that the levels line up pretty well with levels that we're looking at. Let me just highlight a few here. So the 628 swing low from right here comes just ahead of the 50% retracement. That gives you a range of 29.66 into 29.76, 10 pip range. Beyond that, and key resistance, an area of which I would be interested in starting to look for some possible short exposure, is up here. 130.15 is going to be the 5.9 swing low. Oh, I'm sorry, 5.9 swing high right here. Okay. And you also have a basic key 618 retracement of the decline off the highs right there as well, just below it, 130.10 into 130.15. So some interesting areas of resistance. I'd be looking for some possible short triggers on a rally. But for dollar CAD, the immediate focus on this breakout does remain to the upside while above the weekly open near term, basically the 29 handle. And bear with me one moment. I just want to see what this looks like. Look at that. 100% extension comes in right at 129.08, right next to that 526 swing low. And the 1618 comes just higher at 129.45. Look for some play off those levels. Dollar CAD, near-term breakout. Aussie we covered. RBA we covered. Any questions here on Loonie before we move off? So while we're looking at the dollar CAD, let's take a quick look at the crude trade. We'll go back to market scope for that for now. Here's what U.S. oil looks like. And the basic thing that I wanted to highlight here, here's your monthly open, is the consolidation that we're making below key resistance. Remember, crude has been trading within the confines of this descending formation. Yes, we got the break, but it was a very nice break, pivot, and recovery. Median line also gave us a little bit of a break, recovery breakthrough. Here's the upper median line parallel, basically calling the highs here that we made last month. So the focus here near term is on this range. It's the same exact chart that I left last week, guys, on the radar charts. None of the levels have been changed at all. In fact, at this point, we're pushing through that initial opening range from last month to the downside. Your key support still remains right here, which was the May open. You recall last month that gave us perfect support. That comes in at 49, basically 45.99, basically 46 handle, with key support still down here, 44.68, 44.70. That completes two equal legs off the high. So if crude continues to play into this range, again, keeping in mind near-term support at 46, you can see CAD losing some more steam, giving some further upside to dollar CAD in the near term. All right, so you continue to monitor both of these pretty closely. They've been moving pretty decently together over the last few days. All right, so that is dollar CAD and crude. If there are no other questions on that, we will move into dollar Swiss. Here's what Swissy looks like. So last week we highlighted this setup. We were looking for some near-term resistance. As we had highlighted, bottom line, we're coming into some near-term resistance here, extending into 98.39. We topped at 98.32. The focus is lower sub 98.18. Interim support targets seen at the weekly open, 97.50, which we hit, backed by the ML, and the weekly low at 9,700. Here's what dollar Swiss looks like right now. It's been a pretty decent play, actually. So the decline took out, obviously, 9,800. Next downside target there at 97.50. We took out as well, backed by the ML, which was at 97. The low in overnight trade was 96.84. So we've taken out all the targets from that radar chart. Near-term support, I'd be looking at 96.80. This is a basic retracement of the advance, and it coincides with the 50 line of this nice clean formation over the next few days or so. Actually, this is heading into basically tonight, the open of Asia trade tonight. Okay, so I would expect to see some possible weakness here or pull to the downside for dollar Swiss. A break above 97.37, this confluence region right here. Okay, there's a couple of reasons I would use this as sort of a near-term breakout play. Okay, it's that median line or the 50 line extending off the high for the broader formation that we've been following. Again, if you take this into the daily chart right here, this 50 line. Okay, B, you have the actual median line from the ascent off the lows. Okay, and C, that would necessitate a break of the weekly open, which we're currently checking as resistance. So if you guys see a pop above 97.37, I would expect a little bit more of a recovery to the upside for dollar Swiss before we turn over. I do favor the short side, generally speaking, just because of our broader bias in the dollar, the turn in price action that we saw near the highs. If we bring up our 60 levels here in momentum, which for some reason I didn't tack on here, you can see a really clean and profound turn here right at 60. Okay, which is pretty indicative of some further near-term weakness or that the downtrend is starting to pick up pace. Remember, from above 60 to below 60 really changes things. On the way up, if that bias is to hold constant, you would want to see resistance at 60 in momentum. Okay, so near term, you could see a little bit of a pop higher. Keep in mind that 100-day moving average comes in at 97.50, pretty close to where the monthly open is as well. And again, obviously, if we do find some resistance here and jump on the short, the downside target subsequent to 97.80 or 96.80, excuse me, would be right down here. Key 618 retracement, lower median line parallel. That takes you into 96.40. So let's see if we can't get a little bit of a push higher here in dollar Swiss to jump back on the short side. Any questions on Swissy? Okay, I just wanted to highlight on the 9th, which is actually Saturday, interestingly enough, you do get CPI figures from, oh, that's from China. Something to keep in mind there this weekend. Ah, there it is. So on the, I was looking for the right one. For Switzerland, there you get the CPI numbers on the 7th. Okay, so on Thursday, you're going to want to pay attention to these as the Eurozone as a whole, or Europe as a whole, continues to fight this deflationary or disinflationary environment. You'll certainly want to be looking at those CPI numbers that come out relatively early there on Thursday. Okay, moving right along. Remember, near-term support 96.80, key or near-term resistance 97.40, critical resistance 98.63 for Swissy. All right, let's touch real quick on the majors for euro and pound, and then I do want to take a moment to talk about gold, which is coming into an interesting area of resistance as well. Here's what euro dollar looks like on whole for the daily chart. And for the 30-minute chart, look, you're coming into resistance any way you slice it. Ideally, as me and Jamie were talking about all of last week, sort of the major key resistance would be really, really interesting for us as far as being able to jump in a short position with some conviction, would be a rally a little bit higher, back towards 112.30. 112.30 has so much lined up there. On the 30-minute chart, you have the 100% extension off the low. You have the 618 retracement of the Brexit decline. Okay, and you have the 100-day moving average, all in this region right around 112.30, 112.24. Okay, before that and ahead of that, you're coming up on some major, major resistance confluence though, and that's right here at the 50% retracement. Okay, you have the lower median line parallel extending off the lows from last year, from late last year. You have, as I said, that 50% retracement. The current operative structure off the high coming in really nice with the median line right in that region. Okay, and overall should offer some near-term resistance here on this rally. Now, if we do get a topside breach through this, I'd be interested in playing that rally towards 112.30. There's a nice range there on some pullbacks to get some long scalps towards that key region. But I really wouldn't be looking to target anything beyond 112.30. In fact, like I said, that'd be a really nice area of which I'd start to look for some possible short exposure here on euro dollar. Okay, long story short, there's no play here just yet. You're checking resistance as basically today's highs was resistance. Okay, so if we get a rally back towards today's high and you start to see some nice short triggers in near-term price action, absolutely that'd be something I'd be interested in. Keep in mind your support is going to be at the monthly open, which comes in at 111.05, and the 200-day moving average comes in just lower at 110.96. So clear level of which if we do break to the downside, I'd be more than happy to get on some short scalps here for the euro dollar. A quick note, I do see some new names here in the room, guys. Don't forget, any chart that you see presented on any of our webinars here on SB, you can take a quick snapshot by clicking on that camera in the top right-hand corner of your GoToWebinar screen. So if you need to reference these charts later in the trading day, you have them at your disposal. So that's euro dollar on the daily chart. The 30-minute chart, here's what it looks like. Again, this is the confines of that descending median line formation that we just looked at in the daily chart. There's the median line catching the highs today. Really nice reaction off it. The break below to get the downside going would be a move sub 111. Okay, again, as we covered in that daily chart, you also have basic trendline support, which is a parallel, by the way, of these two lines that we were looking at last week, these 2 points. If we just take a parallel of that trend line to the downside off the stretch low we made on Brexit, you can see it catching the lows very nicely. Coincides right now with the monthly open. All right, so I expect this to be a little tight here, guys, to open up the week. Remember, we're likely to have still pretty contracted market participation. The extended weekend here for 4th of July typically spills over for a couple of days, so you might not get full market participation yet for another day or so. Also, keep in mind heading into Friday, again, you're likely to see that participation start to dwindle down a little bit. So for the open of the week, it's not too bad an idea to be a little bit more nimble. I think we get a lot more play on some of these majors once we clear some of the opening ranges here to start off July trade. Any questions on Euro? The levels are pretty clear. All right. All right, let's jump into the British pound. Here's the pound looks like first on the daily chart. Um, and this is one of the reasons, it's funny working in the business. As soon as you see something like this happen, I don't know if you guys have been getting it too, but every single family member, friend, acquaintance, anyone that you've come in contact with that knows that you guys trade currencies probably contacted you last week saying, hey, how can I buy the pound? Should I buy the pound? Is now the good time to get into that trade? And my response to all of them was, wait. We're likely to see a lot more downside. The full impact and the precedent that that's going to set still hasn't been fully recognized by markets. And I think we got that exact quote yesterday from the RBA, right? Saying that we had the Brexit vote, the effect of the Brexit vote on the global economy remains to be seen. So that being said, from a technical standpoint, it's not ready either. Okay. And one of the reasons is because if this was going to be a flush out of just a basic 100% extension from the decline, you had basic channel support, this should have offered something way more than what we got. Keep in mind, we still haven't even filled the Brexit vote gap. And if we are to do that, we would need to move into this region here. Okay. So the fact that the rebound here was a mere, very, very weak rebound off of a support that you would have thought would have given you more keeps the focus lower. Again, also keeping in mind that momentum didn't even make it for a rally into 40. That suggests that the broader pressure still remains heavily weighted to the downside here. Mike, I'm not very familiar with TradingView. What is the lower line under RSI? Oh, my man, this is just ATR. We don't have the ATR and pips indicator like we did here in MarketScope. So where typically on these 30-minute charts, you're looking to scalp 25% of the daily ATR. We're going to have to do that calculation manually now. I'm sure that there's going to be an indicator written for it. If not, I might just do it myself. But in the meantime, this is just a good way to get the daily. I only have it on the daily charts. So looking at like 270 pips here on a daily basis for the pound. Obviously, that's greatly skewed by the Brexit vote, but just gives us a little bit more of a tell on where we should be looking to take our profit targets. Make sense, Graham? So yeah, guys, this is just the ATR that we'll use for now until we get that indicator scripted for TradingView. But long story short, for the pound, we're breaking channel support. If we close below here today, sayonara. I don't want to get all doom and gloom, but really your next downside target is until 127.97. This is 786 retracement of the entire decline, or the entire ascent rather. Got to go back to the monthly chart to go back this far, or the weekly. This is the entire ascent off of the 1985 low, excuse me. Again, guys, if you're using FXCM's platform, they don't have data past 93. So if you go to TradingView and look up pound sterling under FXIDC, it's a different feed for the pound sterling cross, and it goes back way, way further, okay, back into the 90s, 80s, and even pre-80s. So with what the pound has done in recent price action, you do need to go back to those levels for your analysis because you have no precedent on these levels in recent history. Right, so this is a 786 retracement of a 1985 rally to the highs that we made back in what month was that? Late 2007, early 2008. All right, so that would be your next downside target on a break from here. Let me take this back to the daily chart. That'd be your next downside target in a break from here. Again, from a scalping standpoint, I don't really feel like chasing this. If anything, I'm not going to be looking for bottoms per se, but as we come into a little bit more structural support. So if you let me take a step back again. Sorry about that, guys. If you take the basic slope off the highs, okay, this is the high that we made in 2007 again. If you take a slope off that high, copy it to the high that we made in 2009, excuse me. Same slope here. All of those coincide on that 786, basically heading into the start of or the end of August trade, start of September trade. So I wouldn't be too surprised, guys, if this is kind of a no trade zone, back and forth chop for a couple of weeks. Remember, no one really still knows the broader impact of Brexit. You're getting all these guys, even even the chief candidate that was running in favor of the Brexit is not looking to take charge right now. So there's still a lot of unknowns. These are the levels I'd be paying attention to. The 30-minute chart really doesn't have anything exciting in it, guys. You can play real near-term opening ranges for the sessions, for the week, but even then, it's going to be a tricky trade on the near term. So keep your broader focus on these levels. If we start to approach them, set some alerts for yourself. I would be looking for some reaction either off 127.97, or if that breaks, the key 618 retracement of the entire 1985 rally comes in down here at 124.50. And if these levels seem like a stretch, if you find yourself asking, whoa, Mike, I think you're getting a little bit ahead of yourself on some of those downside targets, remember where we've come from, guys, and where we're trading now. Okay, we're basically 2,000 pips lower. So another 300 pips to move into the 786, it's nothing. Not in the grand scheme of what the pound has been doing over the last couple of weeks. Hussein, definitely. Euro pound. Oh, yeah. Great trade. Thanks for bringing that up. I'm going to write that down. Any questions here on pound before we move off? Here's the pound docket. Looks like this week. Next major event risk is going to be industrial production numbers on the 7th. You're looking for a decline there. Manufacturing production comes out on the same day. Also looking for a dramatic decline from the previous month. And then we wrap up the week with trade balance figures, which should be pretty limited impact. Remember, non-farm payrolls is still going to steal the show for all the dollar crosses this week. All right. Let's jump into euro pound. Hussein, since we covered euro and since we covered pound, here's what euro pound looks like. And that, my friends, is what we would like to call a breakout of monumental proportions if, and only if, today's close materializes in that region. So again, the daily chart's really the only thing you want to focus on here. Remember, again, for anyone who's near-term trading this, these are pound pips, so a much larger trading range. But a couple things I want to point out. A, basic trendline resistance off the highs that you made from that March 17th high in 2009. Tagged again in October of that same year. We just broke through that. Ascending median line formation that's been in play essentially since the lows from last year. Caught the highs. Nice pivot around the median line. Caught the lows for the most part. Here's the breach. And a basic 50% retracement from that high that we made in 2007, 83.70, also compromised on this break. So if we close above this region, momentum is an overbought condition, never a time to try to fade anything. In fact, this is when the market has the most push behind it. So on this stretch, guys, I really wouldn't be surprised if we move into 87, the 618 key retracement of that major decline. Let me just see this real quick. Yeah, I mean, even if you take a sliding parallel from the high that you made there in 2011, is that 2011? Yep. You can see again it caught the 2000 and keep putting this in the way here. 2013 highs, and that coincided dead on with that region that held for pretty much the entire week after Brexit until we popped higher here. So the focus for me, Hussein, on euro pound would be constructive while above the monthly low, the monthly open, excuse me. The monthly open comes in at 83.43. I'd be looking for a constructive approach targeting 87.09 to the upside. As far as the near-term chart for this, you don't really want to spend too much time on it. I mean, I think the broader picture here is pretty clear as far as where this thing structurally needs to go. You'll have to look at sort of a 4-hour chart to get any type of reference on price, but same levels mapped out. This is a pretty huge region near term. As long as you stay above the monthly open, I'd like to stay on a constructive approach here for euro pound. And it kind of makes sense, even if you look at it, Hussein, from a fundy, if you were to state it as such, a fundamental standpoint, right? You'd expect the pound losses near term to outpace that of the euro losses. Although I do think ultimately, if this does all materialize, that the euro does risk the bigger decline near term as markets sort of digest on a day-to-day basis the developments coming out of the UK. Yeah, I do think the pound is likely to be under pressure and outpace sterling losses, which should keep this rather well supported. He says, great, thanks. Hey, you're more than welcome, Hussein. Good question. Mir wants to take a look at dollar yen and the SPX, so let's do that. Dollar yen. Oh, the dollar yen. I did not, believe it or not, update the dollar yen on market scope yet, so let's... Nope, not yet. So let's go back to, or on TradingView, let's go back to market scope for this. Oh, I see a question on SPX. So before I switch the, because it's a different platform for me, Hussein, or Mir, excuse me, here's what the SPX looks like before I switch over. And then we'll definitely come back to dollar yen. I don't know if I have SPX here. Let me check. I do. Okay. Yeah, okay. I think I have it mostly covered. So let me just give you 1 sec here. Map out some levels for you. Here is the... Oh, this is a 240-minute chart. Let me get the daily chart. Okay, so just to give you a little bit broader of a scope on what we're trading in, this is the broader formation that we've been following for a couple of years here. I know you probably saw this on Jamie's charts as well. You can see we turned right ahead of the upper median line parallel earlier in the year. This is what's called a raised ceiling. Actually, excuse me, it was last year. And here we are just muddling. You're at the top end of the range. And basically for the SPX, there's really nothing to do except look to trade that range until we clear it. The high day close from last year, if you recall, was 21.25. That's exactly where we capped out this year. The high was actually 21.27, so pretty close to that. Really strong rejection. Obviously, again, that was the Brexit vote there on the 24th. But long story short, you're still trading broadly in the same range. Keep in mind one thing, guys. Despite all the volatility that you saw last month, a lot of these major indices, the dollar index specifically, the SPX, essentially closed the month unchanged. Okay, so let me just put this in a visualization process. Here's the monthly. Okay, so you essentially put in a doji off of the opening, off of the high day close from last year, which was the record highs for the SPX. That's not a very bullish thing. Okay, add to that you're getting the markets trying to digest the broader impact here of what's going to happen with the Brexit. I don't have much of a very strong bias here on risk. I do think that the broader trade is still constructive. Near term, I do think you move lower. Your bullish invalidation level, in my humble opinion, would still be along the upper median line parallel here, which coincides very nicely with the actual median line, say somewhere around like 2120. And today's low is right at that 50 line. So you could see a rebound from here to push back into that upper median line parallel before turning lower. But broadly speaking, this is the formation I'm looking to follow. All right, near term. This is a daily chart, but I do think that you risk a little bit more of a drawdown. Remember, stocks are caught in this dichotomy, guys. The Fed holding on an interest rate cut, or interest rate hike, excuse me. The Fed holding on an interest rate hike is supportive of stocks. Stocks don't want to see Fed start raising interest rates because that saps liquidity. So the fact that they're pushing out their interest rate cut expectations for a hike from the Fed is supportive of stocks. On the flip side of that, all this uncertainty that's happening with Europe, China, the Brexit or debacle, that caps their ability to be able to normalize and at the same time really impacts risk sentiment. So investors' willingness to take on risk. So I really have a split opinion here on what the SPX is going to do. If you put a gun to my head, I would say look for short triggers on a rally up towards the upper parallel here for the descending formation. If we do break the 50 line here, I'd be looking for a run right back into the 2016 Open, 2057. By the way, one other thing. Once we get some confirmation that a high is in place, the first thing I would look to do is tack on a quick extension off of the highs. Okay, and also once we have that concrete high in place, a quick retracement just off the range low from last month. So those levels I'd be looking at near term, keeping in mind, again, the actual monthly range highs. Puts near-term resistance here. Key support down here. Mir, does that make sense on the SPX? You basically want to leave room for today's range on a possible rally back towards the upper parallel, but as long as we stay below that, I don't want to get too excited for the long side of risk just yet. He says yes, all right. And as far as dollar yen is concerned, let me bring up that market scope chart. Oops. Sorry about the delay there, guys. I'm going to tell you right now that the dollar yen is still off my radar, at least for anything near term, just because of what we're seeing. I know this chart is a huge mess. Actually, just give me one sec. Yeah. I know this chart's a huge mess right now, but this is what I'd be looking at near term. You're tagging. Well, let me take a step back. The thing that I was sort of taken by was the fact that Brexit decline went through the 50% retracement, 170. It bottomed out basically at 99, and then closed way up here, almost 300 pips higher. And then last week was pretty much a wash. We ran a little bit towards the high. Now we're coming back, taking back that entire range. Here's your July open. And let me just stretch this out a little bit, give us some legs on it. Clean this up. Okay. So if you see all these slopes, guys, so this is the original slope that we were working off of, um, last year. It ended up being really, really nice slope that we followed. Here's a sliding parallel that also offered some really nice pivots in price. If you took a sliding parallel to the highs from December of last year, also capped the yearly high for 2016. If you took a sliding parallel to the lows we made back on that 24th spill of August of last year, also got some nice pivot plays off the lows. If you take another sliding parallel for the actual stretch high you made for 2014, again, coinciding on that 618, on that 50%, retracement that we made. So from here, if we break lower, I have no clue on this, Hussein or Amir, and I'm not embarrassed to say it. I mean, this trade is going to be very, very risk sensitive. If the broader dollar weakness that the seasonals are suggesting do materialize, I do not think you want to play that by way of dollar yen, just because if that ends up being dollar weakness on account of strength in risk markets, then you're likely to see this continue to move off, right? The other risk you play with dollar yen is the BOJ. And the BOJ is in an increasingly difficult position now, especially with the Brexit debacle underway. And if they do decide to intervene, which a lot of people are saying and expecting them to intervene, you could get caught on the wrong side of this trade real quick, real quick. Remember, stronger yen is very detrimental to the Japanese economy. They're an export-based economy. The stronger the yen gets, the less appealing their exports seem, and certainly, or not seem, the less appealing they are. And certainly, it's only a matter of time. We've heard time and time again the BOJ said it's not necessarily where the yen is trading, but it's the speed and the veracity of the movement. And I think post-Brexit, on this decline from 106 into 98, 99, certainly is going to be something that the BOJ is tracking very, very closely. And we've heard them come out and say that they're monitoring the FX moves very closely. So look, Mir, long and short of the story is I am looking lower. It's in a descending formation. Momentum is extremely bearish here. Really, even on that spike back into that 38.2 at 106 and change before the Brexit, momentum couldn't even make it up to test a basic former trigger, right? These are all indications that the broader momentum still weighted to the downside. Also, if you take a look at SSI, which of course is the speculative sentiment index from Daily FX, an aggregate of FX positioning among their client base, which is obviously one of the largest representative client base for FX trading on the retail sector, shows that retail sentiment is still heavily long. So Mir, as long as the retail crowd keeps crowding on the long side of this trade, I'm not really looking to fade it. At the same time, trying to get on the short from a scalping standpoint, sure. If there's near-term structure that does begin to pan out, I have no problem, taking some short scalps on it. But, you don't really have anything as far as a conviction stop is concerned. You're not near any major near-term resistance levels. You're not near any major near-term structural resistance. So for me, it becomes a much harder trade to get involved with. Let me just see if anything comes out. All right. So, sort of initial area of a soft spot you'd look for initial support would be right here, just below, or just above the 101 handle. 101.08, 50% retracement off the ascent from the Brexit low. A 1618 from just the near-term decline, really, really short-term, takes you into 101.25. So this would be a region of which I'd start to look for some possible exhaustion on the short side for dollar yen. But remember, even in that case, you're looking at some pretty serious crowding as far as the trade is concerned on the long side for clients trying to fade this. And that makes me very cautious. And on the top side approach, if we clear last week's high, those are the recovery levels I'd be looking for. Actually, I'll bring this into a 764. Mir, does that make sense for the SPX? Look for the initial downside support. I mean, you're checking basic channel support on a real near term here. So your resistance level that you want to pay attention to immediately would be right around here. That's 102.30. Nice pivot in price last week, but also the upper median or channel resistance comes in there basically into the open of US trade into the close today. And for what it's worth, you are getting some building divergence. Now, these divergence signals sub 30 are the weakest ones you can get, but price action making a lower low, the oscillator holding those lows, making equal lows. Again, you might see a little bit of a pop here, but really I'd need to, for the dollar yen, I'd more be interested in playing the opening range for the week. So last week, despite all the chop and despite all the chatter post-Brexit, you actually got a very basic weekly opening range. Here's your Sunday open. You stretch into a high. You set the low. You check the low, it fails. You break the high. You stay constructive above 102.30, and you stretch into 103.40 before the week closed out. So I think on a trade like this where there's so much uncertainty and the daily charts just looks like a mess, you kind of want to just use basic techniques in near-term price action to give you your signals. But again, as far as the broader trade is concerned, Mir, watch that SSI, man. I hate to see it this high and try to take that same side of the trade. On the extremes, they will tend to be right? So when SSI reaches an extreme, as price is reaching is an extreme, those tend to be pretty strong highs and lows. But as price action continues to move lower, SSI builds on the long side. I'd be very weary to try to fight that. Mir says, yeah, thanks. You're more than welcome, man. Again, I wish I had some more clarity on dollar yen, but I think we get it once we clear out the July opening range. Okay, any other questions? That brings us into 9:29. You got the open of U.S. markets in just under a minute. We'll wrap things up here. We'll be online tomorrow morning, guys, 8:30 Eastern, same time, same place. Hopefully we'll have a little bit more in the docket here as we start to get through the open of July trade. Again, keep in mind, guys, there might be a little bit lighter volume still today on the back of the holiday weekend. So, you might see those ranges blow out a little bit. As we come into tomorrow's trade and head into NFPs, you should see that market participation really start to come back into full effect. Best of luck trading next few days. See you tomorrow morning at 8:30. Cheers, guys.